Hello, I'm Robert, and welcome to my channel, where I talk about everything automated algorithmic trading, or simply algo trading. Today we're going to pick up where we have been talking about the USD JPY experiment with a 5 pip take profit and a 35 pip stop loss. Now this experiment uses an autoclose technique that we discovered from the last video, where we can get out after an hour, since we know that every trade pretty much ends up in a loss with very few exceptions. This is the reveal of that experiment. This is the showing of just how well that process worked. It's an interesting experiment. So let's get straight to it, as you see it on the screen right now running. But let's get down to the nitty-gritty and see the profits. Let's get right into the chase of it. And there we have it. We lost more than the first experiment. But the trades are $100 less for our losses. Every trade we took, we originally lost $257 per stop loss. Now it's only $153 per stop loss. We did better, significantly better. But overall, as you can see from the final balance, it still didn't work right. Why? Well, let's do a bit of a tally here, and let's do some counting. So we have 42 wins. We have 22 losses. So right off the bat, we know since this week began, this market is worse than last week. This market absolutely is atrocious. Last week was better off. That is really the whole point of what this forward test demonstrates, and the critical point of the entire process. Even if you have a working strategy and you know it works over 1,000 or 10,000 trades, it doesn't matter in the short-term span of a few days or a week. And in this particular case, I can tell you from personal experience that I know it's still going to lose at the end of a full 5-day run, because the stop loss is too close to the price level. See, 2 years of experience and experiments have taught me, along with talking with real traders, that your stop loss must be quite large. In my own personal trading, I use a stop loss between 150 pips and 350 pips. Now that's an insane level, but when you talk to real professional traders that do this day in and day out, you get told over and over, you need to let your trades breathe. If it's too close, and 35 pips really is too close, you're going to lose money like you see on the screen. Consistently, over and over, you're going to lose money. Now let's show you what real profits looks like, and why I know this technique really does work. As you can see from looking at my balances, they increase slowly and steadily, and that is the important part. A very slow process that is painful, but still meticulous. So let's really look at these profits. Okay, now that I got my mouse working, this column right here is my profit. And as you see up here, 11 at 34, 728. And over time, slowly creeping up, dollar for dollar. The secret to using large take profits, or large stop losses, is you don't want them to hit very often. When they do hit, they hurt, as I demonstrated several weeks ago when I took close to 13 in a very short period of time in my trading. The take profits are painful. They're always going to be painful. So what you need to do is to realistically mitigate them as much as possible and give as much breathing room as reasonable for your trading approach. Each approach is different, and a flat level, I'm just going to take 200 pips and that's it, doesn't work. In my own case, I use a very dynamic take profit based upon the actual market itself. My take profit changes with each and every trade based upon what is going on in the market. But it is always at least 150 pips away from my entry price, so I can guarantee I have significant room for it to breathe. Now let's go and actually look at, and as you can see through previous trades, over time, slowly and meticulously, profits grow. In fact, in my Patreon this morning, I showed a couple of trades where I got 90 cents plus profit on 2 different trades. That's quite a lot considering how little I actually used to get it. So if you're not a patron, you're missing out on some really good material. That link will be in the description. So it's important to understand, you must give your take profit breathing room. You must give your stop loss breathing room. The market will tell you both of them if you just pay attention to price action, the order book, and what is going on within the charts. So, as we progress and we begin to move forward in actually learning all of this at the algorithmic level, you're going to see why backtesting really is a rosy picture to reality. And you wouldn't notice that unless I did this experiment, unless I really took apart the whole process. That is exactly what this whole process is about. Showing you that the YouTube videos that show you a chart, enter here, exit here, you just earn X amount of dollars. It's all meaningless because anybody can look for the perfect situation on a chart. When you forward test, as I did here, there is no way to know what's going to happen in the market. You could win or lose, or you could lose and win at the same time. That is, you could win 85, 90, 95% of the trades and still lose money. That's why back tests are useless in and of themselves. They don't provide information or make reasonable levels of information that you can really trade with. They give you a direction. They'll tell you win rate versus loss rate, but they won't tell you the reality of a bad market. I could take a back test anytime, anywhere, and it will paint a beautiful picture. But when I go to actually forward test it, as I did here, with this very simple technique in context, you really begin to see just what a lie 99% of all YouTube channels really are. You can't trust a backtest at face value. And there is one and only one exception to that. And that is a pure dollar cost averaging approach. There are many variations of it, Jackrabbit TV being one of them. That is the only time you can trust it, but not enough to go into live trading. Never ever take the information from a backtest and put real money into that process. Ever. Always forward test any backtest 90 days. And even then, depending upon what the instrument or asset is that you are trading, that may not be enough to get a good estimate of just how well the practice will do. You need to really think about your intended purposes. While my profits may be small, my aggregated returns build over time. It gives me a way to mitigate risk. Stop loss is just one tool, but oftentimes it's not the right tool. If you really want to mitigate risk and you want the perfect trading approach, then you'll want two different assets using an accumulation approach that are inversely correlated. This is a true accumulation approach, true dollar cost averaging. And as you can see, it does just what it's supposed to do. It accumulates. This is specifically Jackrabbit TV. And if you choose it, it does have what is called an exit point. An exit point is a dynamic stop loss, where in this case, I know my max number of buys per cycle has been 27. So the golden rule, round up and double, my maximum allowed should be 60. So, but I know that my average is going to be 4 or 5. So that means I can actually use this information so that if I hit the 10th position, rather than continuing to buy into it, I can exit out of it and just accept my losses. Long-term aggregation shows how this works over time. And as you can see, there's one part where the market did really bad, and it accumulated quite a few positions. Accumulation is a slow, tedious process. It's a process that is meant to be profitable by tiny amounts over time. That is the whole context of why accumulation is different than what most people want. Most people look for strategies that look to make money quickly. That doesn't happen. But when you look at the back test, this looks perfect. This looks beautiful. This looks amazing. Throw more money into it and go off and live happy. But that's not how the real world works. That's not the reality of trading. This is the reality of trading. Accepting that losses are going to happen. Accepting that if you go straight from a back test into live trading, it's going to end badly. Accumulation is a process of methodology, science, and mathematics. It's not get rich quick. And anytime you use a stop loss that's too close to your price entry point. You're not giving your trade enough time to breathe. The first rule of any and every market is that no matter what entry point you pick, price is always going to move in the direction you don't want first. Always. There is never an exception in that. You will never ever enter the market and just have it take off straight to your take profit. It doesn't work. If you use a fixed stop loss, then you need to make sure you give that stop loss a lot of room. If you use a dynamic stop loss, as I do, then you let the market tell you where you should place it. And I can promise you, it is not 10, 20, 30, or even 50 pips away from your boundary, from your entry price. And realistically speaking, for those that spend time working in the cryptocurrency markets, 10 pips is 0.1%, roughly speaking. So a 50 pip take profit is 0.5%. If you're trading Bitcoin, that's nothing. But a 50 pip stop loss is also 0.5%. In the cryptocurrency market, that's a wipeout just before you even seen it do anything. You could purchase an entry and get into the market, and then within literally a split second, a 0.5% stop loss is long gone. It's not uncommon to see 5, 10, or even 20% price drops in the cryptocurrency market in a very short period of time. Volatility affects your stop loss. Realistically, if you're not prepared to deal with a 30% stop loss in the cryptocurrency market, as a minimum, you shouldn't be in the market. Because realistically, unless you're using an accumulation approach, you need to really think about just how volatile that market is. Even Forex, where things are measured out 5 digits after the decimal point, volatility is a menace that can wipe you out. So if you don't take that into account with your stop loss, you are going to end up exactly with what you see on the screen. A hot, stinking mess that is going to ruin everything you do. Give your trades room to breathe. Think about the process. And most importantly, the one thing I see and hear every day, as someone that works in this field, as someone that teaches it, a lot of people just don't understand the mechanical process of what algorithmic trading is. And that's something I hope to correct with my Learning Python series, the Jackrabbit edition, where I'm going to actually take apart all of the components of algorithmic trading. What is a moving average? What is a crossover? The mechanical, actual level of showing what they are. A lot of people don't understand how that even works. They think you just draw a line on the screen and the computer just magically knows what you're talking about. No, it doesn't. You have to know what is going on. Yes, you can go out and use some fancy polished library to do everything for you, but then you still don't know what happens when things go wrong. The experiment I have done for the last week and a half has shown clearly you have to understand the very fundamental levels of what algorithmic trading is in order to be successful. If you just go on TradingView and start drawing lines and not understand what is really going on between the chart and the machine, or between your pictures and your money, you're going to lose your money. You must understand how the system really works to be sustainably profitable. It doesn't happen overnight. You're not going to get rich overnight. You can become profitable. You can do well as long as you understand the mechanical process. And part of that mechanical process is understanding why backtests never match reality. You hear it all the time on every single platform. Past performance never equals future performance. Backtesting never equals forward testing. Previous results will never happen again in a forward market. You can't repeat a historical test and then try to trade live data from historical results. The market is always changing. Sometimes it's good, sometimes it's bad, but it's always changing. So as we move forward and I start taking this process down into layers and breaking them apart, you will get a better understanding of what does and doesn't work. Algorithmic trading is a science. You don't need a PhD in it, and you don't need to be an expert in mathematics. But you do need to have the patience to let the thing run while you do your testing. You need to have the patience to be able to test and analyze and wait for the results. You need to use a demo account. And I know from my own experience of having 4 different demo accounts just on one brokerage, running the same asset with 4 different settings and waiting for the results to come in. Those results tell me what I needed to know and how I personally know that a smaller take profit does work over time against a larger stop loss if and only if you spend time researching what number you need for the market. It doesn't happen overnight, and you're not going to magically get the perfect answer on your first trial. I have spent 2 years analyzing numbers, literally ranging from 1% to 50%, and running tests over and over and over at each level across the same data, getting different results and combining and correlating those results against live forward tests like I've demonstrated the last week and a half. This is how I learned what numbers work. This is why I know that if I start at 150 pips as my stop loss, I drastically improve my ability to profit. But I need to be consciously aware that the higher my stop loss is over my take profit, the more inherent risk I will have when I do hit a stop loss. And I will hit a stop loss. There's no way around it unless you just don't use one. And sometimes, depending upon the market and the situation, not using a stop loss is better, because there are better ways to hedge your risk by taking one pair that is correlated for a long-term trend and a second pair that is correlated for a short term or a short downtrend. That is, they are inversely correlated. When one goes up, the other goes down, and vice versa. That is really one of the most powerful tools in protecting your assets. Trade opposites within the market and trade them against each other. So as one goes up and profits, the other is taking on accumulations. And then when they swing back and forth, you will get that consistency between both layers. But you still have a worst case plan in place. You still have some type of dynamic exit point that will work as the market continues to fluctuate dynamically and erratically. I put up a Patreon post today that talked about the influx of artificial intelligence and computerization within trading, and it has had a direct impact on how the markets work. It's a significant impact that does change the landscape of how you trade. You just can't trade using techniques that worked 30 years ago. It doesn't work. Bollinger's MACD, moving averages, they all work, but in today's market, appropriate to today's market, appropriate to the influx of automation and mechanization of trading. You can't use them the way people did 30 years ago and simply sit back and let it work, because it won't. The influx of computerization has changed how we trade on a regular basis. It has changed how we think about profit. It has changed how we think about loss. The tried and true techniques that occurred and were used don't work in today's modern age the way they used to work. Trend following is a different context. Trend following, the way it was practiced 30 years ago, was about stability in the market. You didn't have whipsaws and sideways markets the way we do now. You didn't have to worry about that kind of a process. Your markets didn't move 100 pips a day. If a market moved 20 pips a day, it was considered the end of the world. Nowadays, modern trading, it's not uncommon at all to see a 100 pip move or a 10% move in the market in as little as a few minutes. It's so common that we don't even register it. Back then, you were having financial experts talking about an economic collapse and the end of the world to see changes that drastically. So, when you think about your trading, understand your trading needs to be dynamic. If you use a stop loss, you need to think about that approach dynamically. Using a fixed point take profit is fine, because that really doesn't have a bearing on the end result. You may or may not get as much profits, but it's still a reasonable, solid approach even in modern trading. But your stop losses or some type of a hedging technique must be dynamic. It must flow with the market, or you will end up with what you see on the screen. Even when it works, and it works well, you still lose money. That is the biggest thing that wrecks 90% of all traders on the market, is they don't give the market room to flow. They don't give their trades room to react. If you sit a hard wall into the ground, you're going to hit that hard wall every single time. So as we move forward, I will be definitely getting the Jackrabbit edition of Learning Python off the ground and start talking about some of these simple concepts behind algo trading. It's going to be a fun little exercise and a fun little tour into what algorithmic trading really is, especially when we start taking apart all of the real layers. Using Jackrabbit Relay will simply cover the mechanism between your program and the broker or exchange, the headaches of communicating across the internet. But the actual mechanical process, that's the fun part. That's what makes or breaks any process. And understanding that is really critical to being truly successful. So if you found this video interesting, give it a thumbs up. Help other people find the way to trading properly. And if nothing else, please remember, never, ever take a back test at face value. All back tests are lies, as I have shown and proven with my own research, as I have shown and proven with massive amounts of data. Every single back test on the planet is a lie if you take it at face value. You cannot. You have to test it in a forward market, always, every time. And really, if you just want to get down to the real world mechanical process of algo trading, backtesting is technically worthless because it doesn't give you all of the things that can go wrong in a real situation, like connection errors. And connection errors can really wipe your account out. But we'll get into that more as we actually start building bits and pieces of a process. If you haven't spent time with my Learning Python series, or don't have a basic understanding of Python, it's worthwhile going and watching a few videos on that. My Learning Python series is a bit of a crash course. You're not going to be an expert in it, but you're going to get a basic understanding that will work as we move forward. So give this video a like, subscribe if you're not and you want to get into the real world of algo trading, the real world of actually what it means to get the machine to work for you. Thank you for watching, and until next time.